For generations, silver investors have leaned on a single number to guide their decisions. It's called the gold to silver ratio, and it simply measures how many ounces of silver it takes to buy 1 ounce of gold. When that number climbs above 80 or 90, silver is considered historically cheap. And when it drops toward 30 or 50, gold looks like the stronger buy. But in recent years, a growing number of skeptics began questioning whether this old rule still applied. Their argument was simple. The world no longer runs on gold-backed money. Gold is treated as a central bank reserve asset, while silver behaves more like an industrial metal, tied to factories and technology rather than monetary policy. According to these skeptics, the old relationship between the two metals had broken down for good. That claim didn't sit well with researchers at the Silver Institute. Working alongside a respected research firm called Precious Metals Insights, they set out to test the theory properly. Instead of relying on opinions, they built one of the most detailed studies ever conducted on this topic, drawing on 3,000 years of historical data and 56 years of daily market pricing, stretching from 1970 all the way through to mid-2026. Their conclusion surprised many people. The skeptics, they said, were wrong. The ratio wasn't broken at all. To understand why this matters, it helps to look back at history. Thousands of years ago, the relationship between gold and silver wasn't just something traders watched. It was often written into law. In ancient Egypt, silver was so scarce that it briefly traded at a ratio close to 1-to-1 with gold. Centuries later, under the Roman Empire, the ratio settled near 12-to-1. Even the founding fathers of the United States factored this relationship into their financial planning. When Alexander Hamilton helped draft the Coinage Act of 1792, he fixed America's currency system at 15 ounces of silver for every 1 ounce of gold. That kind of fixed relationship lasted for centuries, right up until governments around the world gradually abandoned metal-backed currencies. The turning point came in 1971, when President Nixon ended the direct convertibility of the US dollar into gold. Once that anchor disappeared, many assumed gold and silver would begin drifting apart entirely. Gold took on a new role as the world's ultimate safe haven asset, something central banks and investors turned to during uncertain times. Silver, meanwhile, developed a kind of double identity. It remained a monetary metal in the eyes of investors, but it also became essential to modern industry, showing up in electronics, solar panels, and medical equipment. So did that shift actually break the old relationship between the two metals? This is exactly what the Silver Institute set out to answer using rigorous statistical testing. And their first major finding was striking. The ratio, they discovered, is not what statisticians call a random walk. A random walk means a number simply wanders without any structure, pulled around by pure noise. Instead, their research proved something very different. Across more than 50 years of data, from 1970 to today, the ratio consistently returns to a long-term average of just under 60-to-1. The precise figure they calculated was 59.8-to-1. This finding carries real weight. It means that whenever the ratio strays far from that number in either direction, history shows it eventually snaps back toward the center. During the precious metals boom of 1980, the ratio compressed dramatically to around 17-to-1. During the 2011 bull run, it tightened again to roughly 31-to-1. And during the panic of 2020, it briefly spiked to an extraordinary 126-to-1 before sharply reversing course. Even more unexpected was another discovery buried in the data. Over the last 2 decades, as exchange-traded funds, derivatives, and algorithmic trading became more common in the metals markets, many assumed gold and silver would move further apart. Instead, the opposite happened. Their price relationship actually grew stronger, not weaker. This sets the stage for a much deeper question. If the ratio really does have a natural center of gravity near 60-to-1, what exactly pushes it away from that number in the first place? So, what actually pushes the gold to silver ratio away from its natural center near 60-to-1? According to the Silver Institute's research, the answer comes down to 2 main forces working together. The first is the balance of above-ground bullion stocks held in gold versus silver. The second is the balance of investment demand flowing into gold versus silver. Together, these 2 forces explain most of the swings the ratio has seen over the decades. This is where the report reveals its most important discovery about today's market. Above-ground bullion stocks, researchers found, are heavily shaped by what's known as the official sector. In simple terms, that means central banks. And central banks have been on a historic buying spree. Over the past several years, monetary authorities around the world have been purchasing physical gold at the fastest pace seen in modern history. Their goal has largely been to reduce their reliance on paper currencies, particularly the US dollar, a trend often referred to as de-dollarization. Now here's the key detail that changes everything. And while central banks have been accumulating gold aggressively, they have been buying almost no silver at all. There has been occasional talk that Russia's central bank may be holding some silver as part of a strategic stockpile, but this amount is small compared to gold purchases. Other institutions, such as Saudi Arabia's central bank, have shown interest in silver exchange-traded funds, but that is different from holding physical silver bullion in reserve. Because central banks are buying gold almost exclusively, they have artificially distorted the balance between the two metals. According to Precious Metals Insights, this wave of central bank gold buying is the single biggest reason the ratio has been pushed above its long-term average in recent years. For anyone following the precious metals market closely, this explanation lines up with a trend that has been building since 2022. This detail leads to an important conclusion in the report. When the ratio strays far from its historical average of roughly 60 to 1, that does not mean the old relationship between gold and silver has permanently broken. Instead, researchers describe these periods as signs of temporary market imbalance, essentially prices that have drifted away from their natural equilibrium and are waiting to correct. There's another important piece of context worth understanding. Silver is currently in its sixth consecutive year of a global supply deficit, according to the Silver Institute and the research firm Metals Focus. This means the world is using more silver than mines are currently producing. At the same time, industrial demand continues to grow steadily, driven by solar panel manufacturing, electrical grid upgrades, and the expansion of artificial intelligence hardware, all of which rely on silver's unique properties. It's worth noting that demand from the solar industry has started to soften slightly as manufacturers find ways to use less silver per panel, a process known in the industry as thrifting. However, this modest decline is being offset by rising demand in other industrial areas, meaning total industrial demand remains strong overall. So what happens when investment demand eventually shifts? Historically, when private investors move their money from gold into silver, chasing stronger returns, the ratio doesn't simply return to its average of 60 to 1. It tends to overshoot, sometimes dropping down to 40, 30, or even lower. That said, researchers are cautious about repeating history exactly. Given how heavily central bank gold buying has distorted the picture since 2022, some analysts believe a more realistic target might land closer to 45 or 50, rather than the extreme lows seen in past cycles. To put this in perspective, when silver spiked above $121 in recent memory, the ratio had already fallen to around 44 to 1. That was considered an unusual and rare circumstance, not the norm. This suggests that while a return toward historical extremes is possible, it shouldn't be assumed as a certainty. What all of this means is simple. The ratio isn't random, and it isn't broken. It's being held above its natural average largely because of one specific force: central banks buying gold and ignoring silver almost entirely. Now that the numbers have been laid out, it's worth asking what all of this actually means for everyday investors and the broader economy. If the gold to silver ratio truly has a natural center of gravity near 60 to 1, and it's currently being pulled away from that center by central bank behavior, then the implications reach far beyond a simple chart on a screen. The first and most direct consequence involves silver's relative value compared to gold. When the ratio sits well above its historical average, it suggests that silver is priced cheaply compared to gold, at least by historical standards. This doesn't guarantee that silver prices will rise. It simply means that relative to gold, silver has more room to catch up if and when investment patterns shift. For long-term investors who watch these relationships closely, this kind of imbalance has historically been an important signal worth paying attention to, rather than a guarantee of what happens next. The second consequence relates to central bank policy itself. Because monetary authorities have been buying gold almost exclusively, their actions have effectively reshaped the entire precious metals market without directly touching silver at all. This shows how decisions made by a small number of powerful institutions can ripple outward and influence prices for everyday investors, even those who have no direct connection to central banking policy. It's a reminder that global financial decisions made far from Main Street can still shape what happens in local coin shops and investment portfolios. There's also an economic angle tied to industrial demand. Silver isn't just a monetary metal, it's a critical industrial material. It plays an essential role in solar panels, electrical wiring, medical technology, and increasingly, artificial intelligence hardware. Because the world is currently using more silver than mines are producing, for 6 consecutive years running, this creates a structural pressure point. If industrial demand keeps climbing while supply struggles to keep pace, that imbalance could eventually put upward pressure on prices, regardless of what investment demand does. From a social perspective, this story touches everyday people more than they might realize. Many households hold physical silver in the form of coins, bars, or jewelry, often passed down through generations or purchased as a hedge against economic uncertainty. When researchers describe a metal as being priced below its historical equilibrium, that carries real weight for these households, some of whom view silver ownership as a form of long-term financial security, rather than short-term speculation. It's also worth presenting a balanced view of the situation. Not every analyst agrees that the ratio will snap back toward its historical average anytime soon. Some point out that central bank gold buying shows no signs of slowing, meaning the distortion the report describes could persist for years rather than months. Others note that markets can remain imbalanced for extended periods before any correction occurs, and predicting exact timing has always been extremely difficult, even for experienced researchers. There's also a political dimension worth acknowledging. Central bank gold buying is closely tied to broader trends of countries seeking to reduce their dependence on the US dollar. As long as that trend continues, whether driven by geopolitical tension, economic strategy, or simple diversification, it will likely keep influencing the relationship between gold and silver. This means the story isn't just about metals. It's connected to larger shifts happening in global finance and international relations. Taken together, these consequences paint a picture of a market shaped by forces much larger than any single investor. Central bank policy, industrial demand, global supply constraints, and shifting investment trends are all pulling on the same rope in different directions. For now, the research suggests silver sits in a historically undervalued position relative to gold, but turning that historical pattern into a confident prediction requires patience and a clear understanding of the forces at play. So, where does all of this leave investors moving forward? The research makes one thing clear. Nothing about this report guarantees that silver prices will rise tomorrow, next month, or even this year. Markets are influenced by countless short-term factors, from economic data to global events, and no historical pattern can predict those with certainty. What the research does offer is a longer-term perspective, one built on more than 50 years of data and centuries of historical context. The central question now becomes what could actually trigger a shift back toward the ratio's historical average. According to the researchers, there are a few realistic possibilities worth watching. One is a change in central bank behavior. If gold buying from monetary authorities slows down, or if any major central bank begins adding meaningful amounts of silver to its reserves, that alone could start to rebalance the ratio. Another possibility involves private investors. If more individuals and institutions decide to shift money from gold into silver, seeking stronger potential returns, history suggests that movement tends to happen quickly once it begins. There's also the ongoing supply story to consider. With global silver supply now in its 6th consecutive year of deficit, and industrial demand continuing to grow through solar energy, electrical infrastructure, and artificial intelligence technology, the physical availability of silver could become an increasingly important factor. If mine production doesn't catch up with demand, tightening supply could add additional pressure to prices over time, separate from anything happening with the ratio itself. For everyday viewers watching this story unfold, there are a few practical takeaways worth considering. First, understanding the gold to silver ratio gives investors a useful historical tool, but it should never be treated as a guarantee or perfect predictor. Second, staying informed about central bank activity, which is often reported through organizations like the World Gold Council and the Silver Institute, can offer valuable context for understanding broader market movements. Third, keeping an eye on industrial demand trends, especially in fast-growing sectors like solar energy and technology manufacturing, can help investors understand the fundamental forces shaping silver's long-term value beyond just monetary factors. This brings up an important question worth reflecting on. If history shows that imbalances like this eventually correct themselves, how long might investors realistically need to wait? Is this a story that plays out over months, or could it take several more years, especially with central bank gold buying showing few signs of slowing down? These are the kinds of questions that don't have easy answers, but they're worth thinking through carefully rather than reacting to headlines alone. Viewers are encouraged to share their own perspective. Some may feel confident that silver is entering a period of historic opportunity. Others may remain cautious, pointing out that markets can stay imbalanced for a long time before anything changes. Both viewpoints deserve consideration, and hearing different perspectives often leads to better informed decisions than following any single opinion alone. Looking ahead, the coming months will likely bring more clarity. Central bank buying reports, updated supply and demand figures from organizations like Metals Focus, and shifts in investor sentiment will all offer new pieces of this ongoing story. Anyone interested in precious metals would benefit from following these updates closely, rather than trying to predict outcomes based on a single report alone. At its core, this story is about more than just a mathematical ratio. It's about understanding how global forces, from central bank policy to industrial innovation, continue to shape the value of metals that have mattered to civilizations for thousands of years. Whether history repeats itself in the months ahead remains to be seen, but the data offers a compelling reason to keep watching closely. That wraps up today's deep dive here on Currency Matrix. If this story gave you a clearer picture of what's really moving the gold and silver markets, consider sharing it with someone who might find it valuable too. Until next time, stay informed, stay grounded, and thank you for watching.